What's up, guys? Filming back to back today. Let me go ahead and get into this video. It's about asset classes. I'm going to talk about things that I've discussed before, but it's a lot more detail and it's a lot more knowledgeable right now. So let's start with asset classes. Now, we have a lot of asset classes. What I have with me right now are fixed income, equity, and derivatives. So let's go ahead and start. We're going to start with the fixed income, which are money market instruments, which means they have a debt of 1 year of less, or capital market instruments, which means they have a debt of 1 year plus. So basically, it's all about timing. Either it's 1 year or less, which is money market, or 1 year plus, which is capital market. So money market, they're short term, they're liquid, and they're low risk, easily bought and sold, and they have large denominations. So let me get into it. Treasury bills. I've talked about this before. They're issued by a federal government. Par value equals $1,000. And their maturity is usually in a month to 12 months, so a month to a year. They're highly liquid, no default risk because it's backed by the full faith of our government. And you only pay federal taxes on those things. So the T-bill rate is also called the risk-free rate. So whenever you're looking for market risk premium, we have the risk-free rate, which we always need, and then we always have the rate of the market. So if you're trying to find a discount rate of something, you will have to do par minus market price divided by par times 360. That's number of days to maturity over n. And that is something that we've used in finance a lot, but I'm not really going to get into calculations, just overall specifications and definitions so you can easily understand how these instruments work and if you ever want to invest in them. So CDs, certificates of deposits that I've talked about before, they're issued by banks or depository institutions. They have anything that's $100,000 or more that's marketable. And their maturity also varies, of course, because like we said, these are money market instruments, so usually debt of a year or less. And typically a minimum of 14 days. Yes, that is extremely low, but minimum 14 days. And they're usually liquid in 3 months or less if marketable, and they're also FDIC insured. So the first $250,000 of that is FDIC insured. So therefore, in case anything happens, bank goes insolvent, etc., you will get your money back on that $250,000. If you purchase more, unfortunately, well, that's up to how things go with the bank. But you have it FDIC insured. And you do owe taxes. You owe federal, state, and local taxes. So before you think, well, I'm going to run over to my bank and say, let me grab a CD, just know you're paying taxes from every level on that. Commercial paper issued by the corporations. So they're issued by large credit-worthy corporations and or banks. And they're at a minimum of $100,000 or more. Obviously, corporations and banks that are credit-worthy will not issue something that is low for commercial paper. It's like an IOU in a way. So it matures in 1 to 2 months with a maximum of 270 days. They're usually liquid in 3 months or less if marketable. And they're unsecured, mostly high quality. So they're either AAA or AA rated. As we know, anything below BBB means that you are now speculative grade. You are no longer investment grade. And then all taxes are owed, so federal, state, and local, and they can be asset backed by collateral. So, bankers' acceptances. Those things are purchase agreements for a bank to pay a seller for goods at a later date. So you're saying, well, what is a simpler definition? Just think of it as a post-dated check, but the bank is paying. So, sometimes, I don't know how people use checks now, but I think they're still pretty common. So let's say that you can post-date a check that you want to have it paid out when you get paid probably in a week or so. So obviously this means that the purchaser authorizes a bank to pay a seller post date. So you could pay for goods at a later date. So let's say you buy groceries and then you put a post dated check and you say, okay, this comes out in 3 days. I get paid in 3 days. Here you go. Same thing as a banker's acceptances. Bank accepts equals that now it's the liability of the bank. So if the bank accepts that banker's acceptances, now it's their liability, which means now it's marketable. Euro dollars. So those are US dollars being deposited in foreign banks that accept US dollars. Now, you pay a higher interest rate than US deposits because you're going over to a foreign bank, but it's US dollars being deposited into foreign banks that accept those type of dollars. Fed funds, we know that it's trading in reserves held at the Federal Reserve, and it's it's a key interest rate for our economy. LIBOR, London Interbank Offer Rate. I actually deal with this at work right now, and it is the rate at which large banks in London or elsewhere lend to each other. And it's the base rate for money loans and derivatives, and it's a benchmark for large banks lending to each other globally. Now, other things that we're going to get into are repurchase agreements, which are short-term sale of securities plus a promise to repurchase at a higher price, hence the name repurchase agreement. So those are collateralized loans, and term, which means obviously term, they have a type of date. Term RPs may have a 1-month maturity. Now, repurchase agreements. So it's saying it's a short-term sale of securities plus the promise to repurchase them at a higher price. What's the reverse of that? A reverse RP. You lend those securities out. Now the security title is collateral, and companies can solicit cash to entice those RPs to say, hey, we got cash out here. Come and get these repurchase agreements from us. So that is it for money market that I like to talk about. Capital market. So let's look at these fixed income instruments. So obviously governments issue U.S. Treasury bonds and notes. Bonds usually 10 plus years to about, well, 10 plus years, obviously. Sometimes it may go up to 30, etc. But 10 years pretty much plus. Notes are 5 to 10 years. You have a coupon rate that's paid, which is a percentage of par. And then they pay federal tax. But however, remember, default risk-free because they're backed by the full faith of our U.S. government. You have TIPS, Treasury Inflation Protected Securities. It's just that principal is adjusted for changes in consumer price indexes. And you have agencies that are able to issue bonds are mostly home mortgage related. So municipal bonds I talked about before, they're issued by anything below the federal level, so pretty much your state and local governments. And they are not default risk free because they are variable with their ratings. You have GO bonds, revenue bonds, so general obligation bonds. The entity will pay from general funds, whereas revenue bond is non-guaranteed. Bond is paid back from the revenue of a project that's being worked on. So general obligation bonds, usually anything that's going to be done for the public, whereas you have revenue bonds that are done for having revenue come in, obviously. But there is no state, federal, or local tax. However, just know it's issued by your state and local governments. So we also have the bond market. So you have investment versus speculative. BBB and above, as I said, that means you're investment grade. You're highly rated. People do respect you. Speculative, BB and below, junk bonds, things that people will say, well, that could give us a higher payout, but at the same time, we might lose everything. So would you rather go at somebody that's going to have a credit-worthy bond, or would you rather have somebody that you could get a higher return on, but at the same time, they might default? So it's all about default risk. Do you want to take a risk with going with a higher bond that's going to pay you more, but at the same time, that company or corporation might just default, or would you rather go with somebody that's trustworthy that you will know you will get your money back on? So mortgage-backed securities, obviously, know a pool of mortgages with pass-through with pass-through securities of monthly payments that covers defaults, and private bankers can sell pools of purchase mortgages as securities. So mortgage-backed securities, and then another fact, Treasuries represents more than 1/3 of the entire U.S. fixed income market. So that is it for the money market. I mean, we do have equity securities, but those are pretty much common sense that I told in the first video about it. That obviously got common stock, etc., preferred stock. And then all we need to know is that bondholders can force companies into bankruptcy over lost payments. So that is a good fact to know about it, that you as a bondholder, because you are pretty much holding on somebody's debt, you can force your companies in bankruptcy. I probably wouldn't recommend it, but then again, it's power to the people. So those are just a couple definitions, guys. If you ever want to invest in those things, just run back the video and all my other videos on them. Explain in detail what they are. So thank you guys for watching. I appreciate it so much. I'm going to get into another video after this, and then that'll be it for my recording for today. I appreciate it. Thank you. Tune in next time.